When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name is Jeff Shade, and as always, I'm just here to ask the questions with the words of wisdom and solid advice. Of course, they come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management in Tucson and Mesa. Hey, Jeff, how you doing this morning?
I'm doing good. How are you doing?
I'm doing great, thank you. Calendar says it is the 16th of November. Boy, Thanksgiving right around the corner, a couple weeks away, then the end of the year, so we've got a lot to talk about today. I do want to talk more about the Trump presidency. Of course, we have discussed that in the past, but we'll talk about some things that have come to light here in the last week. The Trump presidency has powered the Dow to 44,000 in the last week or so. S&P 6,000 stocks keep humming. Is this a valid bump in the stock market, or is this just emotion, do you think?
Well, it's a valid bump, all right, but it is driven by emotion. I think both answers to those questions are yes, both. It stands to reason. I mean, Trump is a businessman. We know businessmen, probably are better for the economy in office than somebody that went through poli-sci and, learned how to win elections by lying, cheating, and whatever other means, and smearing the other candidate and trying to put him in jail and kill him and everything else. But, there's, and I'm not pointing at just that party in general, but typically, politicians from any party, had they not come from a business background, don't necessarily know a whole lot about it. There's a lot of people in Congress and, between the House and Senate, there are a lot of businessmen that come from both parties that have done very well, but it doesn't seem like the people that are in charge necessarily have that background. So it's kind of nice to have Donald Trump, who has run, large organizations, vowing to pull Elon Musk in there to help cost cutting and things like that. And Elon Musk has been close to broke several times. And he's rescued some companies in dire circumstance, including his own Tesla, when it was about ready to go out of business. Threw his last $20 million at it, and somehow resurrected it and made it what it is today. So I mean, these people have both. Trump's filed bankruptcy a couple of times on different projects. Had to see how, when the chickens come home to roost, because you overextend and you have to dig out of a hole. These guys have done it. So I'm very optimistic about the future of maybe the deficits. However, there's a lot of things I want to talk about, too, that are not necessarily positive, but are cautionary. I think Trump has a much better chance of digging us out of the hole that we've been in. But if you consider, the last 2 years, savings has largely been negative. Production has largely been decreasing in every sector of the American, manufacturing, it has been going down. Our GDP has been growing based on government spending and government jobs, and the jobs growth has really been fake. We've actually, if you compare the actual total savings compared to the gross national income, it's actually been negative for some time. So we are in a situation where things just don't turn around right away. The other thing that I thought was very, I think is noteworthy is that, and again, I'm not trying to be a pessimist. I'm just like, hey, let's be cautious. Let's assess the situation before we just get all hyped up. Oh, yay, Trump won. Everything's going to be great. The market's going to go up. Well, wait a minute. There still has to be some sort of, and I've been arguing this point for a long time, there's got to be some sort of a fundamental underpinning to support that market growth, and it's largely gone. There are a few stocks here and there that still have, good fundamentals, good growth, but a big part of, why the market should go up and does go up is earnings and earnings growth. We haven't had that for the last few years. Earnings are way down. What it used to be that some of these big companies were growing earnings by 10 to 20% a year. Now they're growing by 3 or 4% a year, and somehow that's acceptable and great, yet the price to earnings ratio is still 20, 30, or 40, or even 60 or 70 or 100, meaning that we're willing to pay, lots of dollars, like let's say $40, we're on a 40 price earnings ratio for $1 of income when this company isn't really growing. So we have to keep some of those things in mind. The noteworthy thing I wanted to get to was that this earnings season, which starts, after the third quarter's over, we finally start reporting typically, a month later. So, November's a good month to figure out what the earnings were during that, third quarter. interestingly, most companies kind of estimate lower earnings than they know they're going to have so that they can come in with higher earnings and surprise the market. And usually earnings season, there's already a tendency to see the market go up. It takes kind of a little pause as we get into, like, October is typically a bad month, not necessarily just because there's a lot of crashes during that time in history, but I think a lot of people want to kind of wait out and see what the earnings come in at in November before they start reinvesting in the market. And that's sometimes why we have this little, what they call Santa Claus rally near the end of the year, window dressing, where, mutual funds and other, money managers want to dump old ones and buy the ones that are on a roll and kind of window dress their portfolios for the end of the year. So that's kind of a typical trend. Here's the interesting thing, though, is last I checked a few days ago, the company earnings, which typically come in 70 to 80% of companies report higher than expected earnings. And that is even on a negative basis. If they expected to lose $2, they only lose $1. If they're expected to make $7 per share or something, they end up making $7.20. And so 70 to 80% is very typical of earnings season beats, when they beat their earnings. This year, last I checked, it was about a 50-50 or even just slightly under 50 that companies were beating their earnings estimates. Now, they were not giving necessarily super high forward-looking guidance, meaning, let's look forward and, we're going to make this money. Some companies were pretty aggressive on their forward outlooks, but most companies usually give a forward outlook that's positive, yet a little bit less than probably real expectations, just so they can build a buffer in there and not look bad to Wall Street. Well, this is about the worst I've seen it, even in the recessionary period when the stocks were going down, even in the last couple of years when we've had a rampant inflation, yet the market's been growing like crazy because of QE, quantitative easing, and they haven't done it just by printing money that's out there for everybody to see and use, but there's been a lot of backdoor QE through banks and through the Fed not collecting on the loans that they bailed the banks out for a couple of years ago when Silicon Valley Bank went out of business. There's been a lot of, I think, gamesmanship and trickery to support the market, from a president administration's standpoint. And it really comes down to, liquidity, which is really fake economics. Now, going back to Trump's first presidency, we had COVID. During that time, there was a lot of money printing, and it was usually to just bail out everybody. We bailed out, commercial real estate owners that didn't have to pay their mortgages. We even bailed out, renters and companies that didn't have to actually pay employees. They would pay them for them. They would pay them for us. If we wanted to jump in there, and we just had a lot of freebies, which actually supported the market during the Trump administration. So, was that Trump administration because earnings were so robust? Well, actually, in the tech market, there really was, because stay-at-home people needed the tech to grow, and some of the companies like Zoom and DocuSign and some of these other companies just went berserk through the roof. And it was largely because of the economic status we were in and the fact that the market was printing money. Now, I think when Trump entered the market, there was something like $16 trillion in debt, and now there's well over double that. And during Trump's presidency, about half of what's in existence today was created during that time. The other half was created since that time. And it's just unsustainable. You can't keep creating $8 to $10 million worth of trillions of dollars worth of new debt during a 4-year presidency and expect there to be anything other than inflation, especially when the supply chain is interrupted. We got most of that inflation right after Biden was in, because he continued to stimulate the economy. But the biggest reason for inflation is really supply chain disruptions. Remember, we had all that supply chain backup because nobody could either manufacture enough goods. All the boats were parked out in the ocean a few years ago during Christmas time. Remember, they couldn't even get into the Long Beach port. They were like 7 to 10 days waiting. That was a supply chain interruption that really started the balls rolling. You can print all the money you want, but if you have all the goods and services competing for your dollars, no matter how many dollars are out there, nobody automatically spends more. They shop for the best deals, whether you have money or not. And that was something that ended. But it continued to end with the horrible policies of business policies of the Biden administration. They stopped our own energy independence, where we could compete in energy. Of course, gas doubled, and so did food and everything else that goes along with transportation and the need for gas and oil. So all the other companies exploited us because of limited supply and didn't supply that. And so all the money that was out there, rich people got to buy stuff that they wanted, and the poor people are going like, oh my gosh, butter $7 a pound. What the heck? I can't afford to eat. And so this just kind of got exacerbated. But a lot of that was because of the business regulations just making it hard for businesses to want to compete. Manufacturing was down. If manufacturing in the U.S. goes down like every quarter, I think maybe except one, since Biden's been president, how is that going to supply the goods and services that we need in order to use up all this extra money printing? Well, it's not. And so when there's a limited supply of goods and services, there's going to be huge inflation. And they've started kind of curbing that more, I think, because so many people can't afford things that they're just not buying things. And most of the rich people probably have everything they want. So I want to enter this period, even though Trump is in office, he's inheriting a horrible situation, a situation that started with his presidency. I'm not dogging on him. I think he's still the best person for the job by far. However, we've got to make sure that he doesn't just decide to cut taxes without cutting spending. Now, I know Elon Musk has got coming in there to do that and help him do that. And I think Trump could do it himself, but he can't do everything. So he's got some really smart people around him. And I am really happy so far with the direction he's taking to, build his cabinet, and some of the people that I've heard are, already in place. Phenomenal picks, in my opinion. He knows how to do it this time. So I think the second round is going to be good. What I'm cautious and scared about is the fact that the inflation that's already happened is still happened. There's still going to be people that can't, make ends meet. Cutting taxes for someone that is having a hard time making ends meet, who isn't really even paying taxes now in the first place, is not going to fix the problem immediately. If you start cutting taxes and cut revenue, yet there's still all this rampant government spending and the needs for, at least to keep what is in place afloat, we're going to have another huge wave of inflation. It's not going to be market friendly. And, I think the smart money is still going to start going to the sidelines, like Warren Buffett. He's not buying into this feeding frenzy of emotion. He's just sitting on the sidelines with somewhere close to $300 billion waiting to buy when the market crashes. The cycles still happen regardless who's president. I think it'll happen still. I think we have to be cautious, but I do also think, having said that, there are sectors of the market that are probably going to be doing better regardless of, what type of a recession or reset period we have, as Trump cuts taxes and does all the things he's promised, cut taxes on tips, cuts taxes on Social Security. I mean, shoot, I hope he can do all those things. But how do you do that when you've got this deficit spending already in the trillions? We're growing the deficit without printing money. We're growing it at 1.2 trillion a year just on the interest basis alone. That's like ridiculous. So there has to be a lot of cost cutting to get this thing in balance. And honestly, I think it's going to take at least 2 out of the 4 years of his term to kind of see that balance take place. And there's a lot of room between now and then for the market to get tired of waiting, to see that earnings really aren't as robust as they don't turn on instantly. It's going to take a while for manufacturers to start manufacturing stuff in America so they can get competitive and create that supply increase that we haven't seen in a while. So I think from a big macroeconomic picture, Trump's the right guy. I'm really excited about the fact that we can probably get this market back to where it is right now with some fundamental valuations that make sense, but I think it'll take years, not months. I certainly don't think it's going to take a few days. In fact, after 3 or 4 days of the market upsurge last week, we did see just this past week some softening, some selling, some, whoa, wait a minute, let's regroup and figure out, why these stocks just went up 10 or 15 or 20%. Why is Bitcoin going through the roof? Is it really, it's still fake. I mean, is it really worth 70, 80, 90, or is it going to go to $100,000 or $150,000 like some people say? Why? Is it just because Trump says it will, or just because Trump's in office? I think there needs to be more than just the feeding frenzy of people, basically buying into the market. And keep this in mind too. Man, I've got a lot to say on this. This question is long, but I'm almost done. Okay. One last thing that comes to mind is the amount of people, and I've said this before, the private households own 60% of the stock. Usually when that happens, there's two things that happens. I mean, we call that the dumb money. They don't have really the inside information that Wall Street has. And I'm talking inside information. I mean, they have insight, to what's going on in the market, just like Warren Buffett does. He knows there's going to be a better time to buy stocks when they're low rather than when they're so outrageously priced right now. The person at home says, oh my gosh, Trump's in, we're going to get better. All the prices are going to go back to where they were before. Not necessarily. Maybe my income will go up. Oh, well, maybe. Let's see. And they just start throwing money at the stock market, whereas the institutions may not be the ones that are buying. They're the ones that are selling into this market rally for the last couple of years. We've seen CEOs, Jeff Bezos, we've seen Jamie Dimon, we've seen Mark Zuckerberg, we've seen all these people that own multi-billion-dollar companies unloading their own stock, I think because they know it's pretty top-heavy, overvalued, and it's a great time to take profits. So we have to be careful and watch the smart money and what they do, and not just jump in because there's a feeding frenzy of all the household stock owners that just keep wanting to buy. Because here's what happens also. If there starts becoming a sell-off, or if it becomes real that some of these changes that Trump's going to make are going to take a little while to actually, support the market in a real way, it's all going to be based on hype and hope. And do you want to base your, future retirement income or your future, portfolio value, your legacy that you leave on hype and hope or fundamental? So I think we have to enter this period with a little bit of caution. I am very optimistic. There are positions in growth stocks, and just because of the deregulation that I know Trump will put in place that will encourage certain sectors of the market that have been kind of forgotten the last few years to kind of get recharged and revitalized. There are undervalued areas in the market that I think are still worth investing in. I'm not giving stock tips or things like that on the radio here because things change every day and you'll hold me to it. But the fact is there are some things that I think are great opportunities that we should look at that are going to be very Trump friendly. But again, we need to be cautious, and we need to not just jump in this feeding frenzy. Just because the market goes up doesn't mean that it's sustainable, logical, and especially when we see a 1,500 point gap in the Dow, like we did right the day after the election. When we see a gap up in the Dow, it's usually manipulation, or it's usually just just weird stuff that happens. Typically, the market will go and do what we call backfilling. So let's just kind of wait and see how this backfilling. I think it started doing that this week. I think we're going to see more of it in the next few weeks in between now and the inauguration. And by the way, we still have the same, pardon my French, bozos in the White House as were in there that caused all this mess in the first place. I mean, Trump isn't in place yet, even though we have seen his presidency have very positive effects on the market, on economy, on the future belief, on consumer sentiment. But, I think we still have to move forward with caution.
We're talking with Jeff Logan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We've been talking about the Trump presidency, what to expect here in 2025 and beyond. If our conversation today has spurred some questions in your mind, we invite you to give us a call here at the firm. 520-780-9059 is our telephone number, 520-780-9059. Request your Premier Retirement Roadmap. It's not going to cost you a dime, no cost, no obligation. Certainly there is no judgment. It's an opportunity for you to sit down with Jeff, ask the questions that you need the answers to put you on a path towards a confident retirement. We can talk about taxes. We can talk about health care. We can talk about new investment opportunities. Basically, we're here to give you a helping hand to help you design the retirement that you've always wanted, that you've hoped and you've dreamed of. So take advantage of the opportunity this weekend. Phone lines are open right now. 520-780-9059. Leave your name, telephone number. Shelley will call you back during the week and set up that appointment. So take advantage of the opportunity right now by calling 520-780-9059. You can also find out more about us online at premret.com. It's PREMRET.com. Jeff, let's continue our conversation here. I'm seeing a headline that says, more free markets, less harsh oversight. Donald Trump's win is about to boost banks in a big way. How is that expected to happen, Jeff?
Well, I mean, I think that just the idea that the economy is going to be stronger, I think what has to happen is, again, the supply chain has to be kind of fixed here. We have to encourage more businesses to compete, to produce goods and services in the U.S. and compete and drive prices down. But also, as people can save money and as prices come down, they'll have more disposable income. Disposable income means they can go out and buy cars and different things and maybe finance things and borrow money from banks. Now, keep in mind, we have the highest default rate on credit cards right now than we've ever had. We also have a lot of banks that, are still delinquent notes. Now, the Fed's kind of propping them up by not forcing them to pay back a lot of that relief they got during the Silicon Valley Bank failure and other banks that started going downhill. They did that bank term funding program, which they haven't collected back. And if Trump continues to, I guess, ask the Fed to keep kicking that can down the road. Now, the Fed and the banks are one and the same. They're partners. They're joined at the hip. They're like Siamese twins. So you can't really hurt one without the other. You can't help one without the other. So they kind of prop each other up. The president isn't supposed to have much influence, We heard Jerome Powell kind of buck this in, well, I don't care if he lets me ask me to step down or anything, I'll do what I want, kind of a thing, and kind of a defiant speech. I thought that was interesting. But the fact is the Fed Chairman Powell was actually appointed by Trump, if I remember right. So, I think you can unappoint people too if they're not doing their job or whatever, and you can appoint new people in place for certain things. But bottom line is he'll probably stay in place. He'll probably, keep trying to do what he can to make sure that the banks don't go out of business. Now, what the banks have to do to make money is they have to loan money. And banks typically do better when, the dollar, value goes up, which it has been lately. They do better when interest rates go up, and they have been lately. Now you're saying, but wait a minute, why interest rates are going down? No, short-term interest rates are going down. If you look at long-term bonds, and we'll just look at, there's a ticker, TLT, you can look at it. TLT, it's a 20-year treasury. And it is down over 10% in the last few months, even since, it's actually down since the Fed has lowered interest rates 50 basis points. And then again, a week or so ago, 25 more basis points. So the short-term interest rates, Fed funds rate, overnight rate has gone down 0.75%. Yet the 20-year bond has gone up over 0.5% in interest, the 10-year bond close to the same. And the aggregate bond market is down between 5 and 10%. So bonds have lost money, which means interest rates have gone up. Banks actually make money when interest rates go up. Smart money knows that on the back side of this, we're seeing, banks can make money because, they can keep charging more interest. If people can save money on all their regular expenditures and gas and everything else, and food goes down, and if we do get some actual de-inflation, we don't have disinflation or de-inflation, we have slower rate of increase inflation, and that hasn't solved any of the problems that are already, plaguing people's pocketbooks now. And that's what has to be fixed. But I honestly think the banks have been a little bit overpriced, a bit over exuberant buying. The banks, they gapped up big time along with the Dow and everything else the day after the election and a few days after that. But I think we're going to see some softening. Banks still have to make money. Banks may not get the preferential treatment they did during an election year, during the Trump years. However, I know Donald Trump wants to make the market do great because everybody thinks that that's how the economy is, and everybody seems to grade the president based on how the market's doing. And I don't think he wants to see the market fail. I think he'll do everything to continue to, unfortunately, I think he'll continue to essentially print money, prop the banks up, give them passes, not make them pay the taxpayer back all the money that they've been loaned. And I know it's in the trillions, in order to save them from going under with the rest of the Silicon Valley Bank and other banks that got in trouble because their bond holdings lost so much value. They basically said, oh, well, we'll buy those. We'll forgive you of that. We'll just buy those bonds back at face value. In other words, the banks don't have to take a 20% loss on a bond they sell, but you and I do. So, if they continue to do that, that's essentially money printing. That's essentially quantitative easing. That's essentially a very inflationary program. So I think where banks might do well during inflationary times because they're part of the problem, maybe the stocks will do well, and that's how we keep up with inflation as we look at these stocks and purchase those. The other thing I think, a sector that's going to do well besides financials, and again, if interest rates start going down a little bit in the long-term market, banks may actually do even better just because people will be able to afford loans, afford mortgages, afford cars, and they can actually do more business with the banks. However, I don't think the interest rates are really going to go down until the economy looks worse. And what we're seeing with the bond market falling and the interest rates going up is really a problem for the market. The market can't sustain higher interest rates and still go up the way it is. They need lower interest rates across the board, not just short term. So again, the problem is a lot bigger than what we hear in a blurb on the news for 10 minutes and then, run and buy stocks because we heard rates are going down. That is, in general, the idea that lower rates make it easier for companies to exist. But we're not seeing it in the market. We're not seeing the market really in sync right now. And that does disturb me.
We're talking with Jeff Ogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Our show is called Premier Retirement. And again, if our comments have resonated with you, if you would like an opportunity to sit down with Jeff on a one-on-one basis and talk about your portfolio, maybe you don't have a portfolio, you'd like to get something started, maybe you do have a portfolio, a financial plan from another advisor, you want a second opinion on that, again, we invite you to give us a call here this weekend. 520-780-9059 is our telephone number. That is the number that you'll use to request your Premier Retirement Roadmap. It is just a casual conversation between you and Jeff to talk about a variety of things: your income plan, investments to support an income plan, maybe a tax plan, healthcare cost, estate plan. no questions off limits. If you've got questions, we've got the answers for you. And again, it's not going to cost you a dime, no cost, no obligation, certainly no judgment. So take advantage of the opportunity to make that call right now, 520-780-9059, and set up that appointment. You can also find out more about us online at premret.com, premret.com. Jeff, it's time for us to take a break. When we come back, we've got listener questions and more when Premier Retirement continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
We so much appreciate you joining us every week here for Premier Retirement on 790 KNST, Tucson's most stimulating talk. We're on for you 4 times a week for your physical fitness, your financial education on the radio. Saturday, 7 a.m., also 9 a.m. and 1 p.m. We're also on Sundays at 11 a.m. If those times are not convenient for you, once again, we're also a podcast. Wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. Okay, Jeff, time for listener questions this week. We'll kick it off with John listening to us in Marana. John says, I'm soon to be 53 years of age. I have $400,000. My Roth and my pension is worth $250,000 presently. I have $172,000 total in debt, and that includes the home, $110,000 on the house, and $62,000 on a car loan at 8.4% and credit cards at 25% interest. Thought about just making a withdrawal to clear up this debt. I can retire at 55 and get a monthly pension check of $4,000 a month. What are your thoughts on this?
Well, I think you certainly have, it depends what your interest, I didn't hear you say the interest rate on your home loan, but you said you have a car loan at 8.4. I think that's a little bit high. You've got 25% in credit cards, which is really high. I don't know that you have a place that you can, get that money readily on an investment. I think it'd be pretty speculative if you thought you could. So $400,000 in a Roth and pension worth $250,000 presently, there's no way I would, think that you could retire unless you're going to make a few $100,000 a year between now and then. And after that, you can live on, very small paycheck. I mean, this is barely going to get you to Social Security. So I think, regardless of, I just think that's a pretty far-fetched thought. I mean, that's me being frank. You've got a long ways between now and Social Security. Your pension $250 isn't going to generate a ton of income. You have a ton of bills, and I'll bet I just don't know a way you could pay off all those loans and live in the next few years on $400,000 in a Roth.
Let's say that he has a mortgage of 3%, Jeff. I mean, should he keep the mortgage with $110,000? Should he get rid of that car loan? And the credit cards at 25%. Take money from his investment portfolio to do that.
Well, I don't know that I'd take money from your investment portfolio. You don't want to take anything from a Roth before 59 and a half. It gets penalized just like any other IRA does. So, I don't see any other savings here. So I wouldn't pay off the house. I'd keep working and pay down and, maybe instead of contributing to the 401k, again, depending on how much you make. But the fact is you got into a big debt hole, and I'm guessing it's because you spend more than you make. So sorry for the frank conversation here, but you've got to turn that around and learn how to spend less than you make or pay off your debt. $250 in a pension is nothing. I mean, that's not going to generate, more than about $800 a month, maybe. It's just not going to do much. And I would imagine if you got a mortgage, that mortgage that you owe 110 on is going to be more than that just in principal and interest, regardless of whether it's 2 or 3% or 7 or 8%. I'm guessing it's probably less. And if you are in a lot of debt, if you got a lot of equity in the house, I hate encumbering a house to pay off, loans at 8.4 and credit cards at 25. But if you can be disciplined, might not be a bad idea to either refi, do some cash out on the house, get a lower mortgage, to where you can actually start saving more of your money, over the next 10 years that you work. And I would say you probably, based on a comfortable plan, how I see people that can live comfortably even without debt, I see you needing to work for another probably 10 years minimum, at least get to Social Security, minimum Social Security age, and pay off all your debt before I think that's a wise idea.
Jeff, he says $250,000 in a pension, but yet he says he's going to get a pension check of $4,000. His numbers just don't compute at all. As you said, with $250,000, probably about $900, something like that. So maybe he's talking about his Social Security along with a pension. What is the maximum Social Security check that you can get these days?
Well, if you wait to full retirement age, it's in the 4,000 range. But if I'm guessing it's not going to be 4,000 a month on a pension at 55. I don't know where that's coming from based on 250. Like I said, that didn't make sense. I was thinking maybe he meant 65. I thought I heard the question wrong, to be honest with you. Mm-hmm. And if you can wait to 65 and get a $4,000 pension check, I think that's a much smarter situation. I also think that $4,000, even if you could get it, to pay off that debt and eat, drive, and pay gas and other things, and I still think there's going to be inflation ahead. I think that's probably not a very good idea. I don't think you should plan on retiring at 55, but maybe if that is a $4,000 paycheck and you can pay down a lot of your debt, then revisit the question at age 55. But I don't see a clear path where I would ever recommend, just go ahead and quit. It'll be fine in 2 years. Well, let's just see what the next 2 years brings. We have a new administration that gives us a little bit faith and hope in the economy and the growth and the inflation getting back under control, and we have a lot of high hopes, but let's see if they can, actually be materialized in a situation where, our new president is inheriting an economy that is not anywhere near as robust as they say it is on the news. You've got more debt than ever. You've got less savings than ever. Just a lot of things that need to, and inflation is still growing on top of the 130% of what happened before. Now, I think a big part of that is going to be drill, baby, drill, get us energy independent again. That's going to trickle through. I mean, talk about trickle down economics. They say, it doesn't work. No, it certainly does. If you can save money on the top line, you save money on all the bottom lines, more comes back to you. So if we can save money on gas, which is kind of the heart and soul of the cost of everything based on transportation, goods and services that have to be, moved around to create these goods and services, then I think we'll have a better chance of getting that under control. Maybe in 2 years, it might look a little bit more, feasible. The other thing is maybe you can get, some, credit cards that'll give you a lower introductory rate for a year or two. Maybe at a 8% or 9% rate, you can pay that down faster. I would look for that. And your car loan, that just seems like between the car loan and credit cards, I don't know how much is car and how much is credit cards, but $62,000, doesn't seem like a quick and easy, let's get out of debt quick type program. And I think let's see how you do the next 2 years and then reevaluate it every couple of years. Again, the information right there doesn't make me very hopeful based on what I've seen in my business over the last 30, 40 years. I really like the idea of having at least Social Security, even though I'm a little skeptical on how that's going to last and how they're going to fix it. I still think that Social Security paycheck is a nice buffer beyond the pension that you can get. And all the extra savings that you can create between now and then and create some sort of an income source in, at least 8 to 10 years from now.
Well, I think John has a couple problems here, one of which is the fact that the numbers just don't add up. Another is he's 53, wants to retire at 55, but he's got $172,000 total in debt. If we don't want to touch any of the investments, I think that just getting on some sort of a debt repayment plan would be the priority here. And of course, do the debt snowball, go ahead and take a look at those credit card debts and put the least to the most and, take any money, pay off the least and go on down the line. And then maybe you sell the car, get a less expensive car. But I think getting out of that debt of $172K is not going to be a very quick process, but it is something that you need to do before you even think about retiring. But John, we appreciate you listening to us. And of course, we'll send you out Jeff's book, Retirement: The Road Ahead. Next question, Roger's in Tucson. Roger writes, in light of interest rates dropping, I'm at a loss as to what to do. I have $400,000 in a high-yield savings account, and I already have $1.5 million in the stock market. My house is paid off, and I have no debts. I have no interest in investing more money in the stock market despite the recent Trump bump. I could buy another piece of property, but I'm not really interested in being a landlord again. Is that too much money to leave in the bank? It's always been a comfort to have a good amount of money in the bank, but is it the smartest thing?
Yeah, you and I'd actually get along pretty good because I'm also skeptical of the Trump bump, as I mentioned earlier in the show. $400,000 in high yield savings, I think that's great. I mean, if you like a lot of money in the bank, do that, but use at least 2 banks. I mean, I would be skeptical of the FDIC coming to your rescue if banks get in trouble. And by the way, they're in a lot more trouble than they look like, and a lot more trouble than what you think the stock is doing. Now, you can follow the money and keep buying bank stocks and make some money, but you don't want to do that because they're overvalued and you feel a little bit skeptical. I also don't know how old you are or if you're already retired. I'm guessing you're probably retired already. 1.5 million in the stock market. You have no debts. You're probably living on Social Security fairly comfortably. Is the 1.5 million in the stock market in IRA money? You might want to consider doing some systematic Roth conversions or even LERP ideas of, hiding your money in a life insurance product that's basically protected by the shell of life insurance that can still grow at 6 to 10. I just did a review. Somebody's up 12% on their life insurance just this year because it is market related. It doesn't get all the market upside, but when the market was plummeting, we didn't lose any money on it. So you can still make some money in some safe places that might give you better upside. And by the way, that's in a tax-free environment. It's kind of like your own tax-free bank. Doesn't issue 1099s. It's safer than a bank because insurance companies actually have money. They don't just borrow everything. They don't borrow it from you and then loan it out, 90% of it over. And then if you put some of that loaned money back in the bank, they actually loan again on it. It can actually be Ponzi scheme to where the banks are upside down overall, unfortunately. But you've got to be careful on how much you keep in banks. You also have to be careful on how much you want at risk. If you're already risk averse, then that high yield savings is going to be okay. Now there will come a time, I believe, when interest rates on longer term assets like the 10-year and the 20-year treasuries, may actually go up again. Right now, the interest is going up, but the price of those bonds are going down. So I wouldn't buy those long-term bonds because the volatility will still, make your head spin. The bond market's down another 10% just in the last month or so. It's still down 20+% since it began the sell-off back in 2022, along with the stock market. The stock market's rebounded. The bond market is still low. Why? Because interest rates are still high. If interest rates on short-term go down, you're going to lose money on the bank assets. But you can go a little bit longer term, maybe secure some more of those longer-term investments. And there's a lot of ETFs and things like the exchange-traded funds that are very well managed, that do some leveraging and pay about a 6 or 7% dividend. And I think they're very low risk. You'll like them a lot better than the stock market. And they seem to have been holding their value in spite of the fact that the longer-term bonds have been going down. They've been holding their value lately. The dividends, at least more than keeping up with any of the depreciation on those assets. So there are some options for you. I don't blame you for not wanting to be a landlord. I tried it a few times during my working years, and I certainly wouldn't want to do it in retirement when I want to actually enjoy peace of mind during retirement. So I'd pare down your money in the bank. Again, $250 is the max they'll insure per account. I also think you need to look at the strength of the banks. Sad to say that the big banks will always be propped up by the taxpayer because they are, basically members of the Fed. The smaller regional banks might be a little bit more precarious. However, many of them are much stronger in funding assets versus liabilities. Their financial strength is a lot stronger than the big banks if you look at the big picture generally. So again, be careful as you enter that world. If you want to talk about some of these other options where you have upside in the stock market through FIAs, indexed annuities, you can actually lock in a long-term interest rate over 5% right now with A-rated companies for 5 to 10 years. If you want to just, put part of that $1 million that was in the stock market, you want to lock in that 5 or 6% range of interest, you can still lock that in. Insurance companies are willing to pay it because they're able to make it out there in the market. So, expand your horizons a little beyond the stock market, and the banks would probably do you a little bit of good. Look at some of these other options that the strongest financial institutions on the planet offer, and that those are insurance companies. Don't know why they get such a bad rap. Well, I do know, because Wall Street own stock in those companies, but because typically it's a buy and hold long-term proposition, you don't get paid fees over and over again on your money. Wall Street doesn't like that business model. So they down talk it and think it's stupid. But I'll tell you what, the most wealthy people in America and in the world use those assets for tax savings, principal protection, and reasonably good growth that will compete against the bond market.
Roger, thanks for listening to us in Tucson. Of course, your book is on the way, Retirement, the Road Ahead. Our telephone number, 520-780-9059, if you'd like to get in and sit down and talk with Jeff. No cost, no obligation, no judgment. Ask for your premier retirement review. You can call that number this weekend, 520-780-9059. Leave your name, telephone number. Shelley will call you back during the week. Again, no cost, no obligation, 520-780-9059. And of course, you can also find out more about us online at primrat.com. Next question is Will listening to us in Vail, and Will writes, I understand there are 2 different 5-year rules for Roth conversions. What my older relative and I cannot figure out is if and how they come into effect for his situation. He's 77 with $2 million in a pre-tax portfolio and has never had a Roth account. If he were to start a Roth account today via Roth conversion, would he be subject to either or both 5-year rules? He's trying to figure out if converting some of his IRA to Roth is a good idea at his age of 77?
Well, I think you can convert a Roth at any age as long as you don't go into a new tax bracket to do it. If you've got a ton of pre-tax portfolio, even at 77, would it be, wise on $2 million pre-tax portfolio? I mean, he's already kind of knocking at the door of high tax bracket. So I don't know, it might be kind of too late, but I don't think it's ever a problem if you want to take advantage of lower tax brackets that are available today through the Trump tax cuts of a few years ago that are set to expire next year, but will likely be extended now that Trump's back in office. So there might be some more time to do some Roth conversions. The nice part is that you're kind of prepaying the taxes for your heirs, at that age. You're already at RMD age. You're already taking, 5 or 6% out per year of those, as a withdrawal. $60,000 or $70,000 is probably what the RMD is on that. But if that plus Social Security puts you at $100,000, and you could go up to $300,000 or $400,000 in assets before you pay a higher tax bracket on it, then maybe it's wise to, get out of a couple $100,000 a year and pay those taxes now so that your heirs won't have to, especially if they're going to inherit the assets while they're working and only have 10 years to pay taxes on them. You might end up putting your heirs in a big predicament if you're making 8 or 10% average over time on your pre-tax account and only taking out 5 or 6, it's going to continue to grow. So again, it kind of depends on the overall picture. I always believe you should pay taxes on less money at a lower interest rate. If that can happen through Roth conversions, then you should do it. If it can't happen, then you just kind of bite the bullet and ride the wave, unfortunately, and continue to pay taxes as you go and hope they don't raise tax rates too much. But as far as the 5-year rule, once you've opened a Roth, the 5-year rule starts ticking. And the only thing that it says is you just can't withdraw the earnings on that Roth account for at least 5 years. So if you put $1 million into a Roth and it made, let's say, $200,000 over the next 5 years, you could still take the whole $1 million out over the next 5 years because you've already paid taxes on the principal. So that's the main 5-year rule that I think people don't understand. A lot of them think that you can't take any distributions from the Roth account. That's not true. It's just the profit on it that can't be taken out within those 5 years. Oh, and by the way, the issue about converting with the IRMA, that's if you convert $200,000 or $300,000 a year for, let's say, the next 10 years and convert that Roth, you're going to have huge IRMA. That's the income with respect to your adjusted income, basically, for Medicare premium. So if you don't want to pay $400 or $500 a month for your Medicare Part B, you could just do a one-time bite the bullet on a bunch of it, pay taxes now thinking, well, I'd never have to pay taxes again. It will probably put you in a higher tax bracket. You have to kind of weigh those odds. But, that's the only way to get out of it. You can usually talk your way out of a one-time conversion or a one-time situation where you convert and you say, hey, that was just a one-time Roth conversion. Can I get out of it? And typically they'll give you a pass. Or if you sell a home, or if there's some weird situation that causes you to jump into a high tax bracket that you'll probably never be in again, you can usually wiggle yourself out of that. However, I would rather pay, an extra $3,000 or $4,000 in IRMA penalty or premium and still pay tax on $1 million at 24% over the next 4 or 5 years than I would rather go into a 36% tax bracket one time. So again, you have to do the overall math, and it's really, in the end, how much you keep over the term of this Roth conversion or potential Roth conversion compared to what you would spend in either higher taxes or higher IRMA.
Well, we appreciate you listening to us in Vail, and of course, we'll send you out Jeff's book, Retirement, The Road Ahead. Next question, Jeff, is interesting. Rob is in Oro Valley, and Rob says, I'm 55 with $2.5 million in Apple stock that I bought 30 years ago, and now it's all capital gains. Can I use these funds for the first 5 years of my retirement? Now, Jeff, I looked up the closing price for Apple stock in 1994. Can this be true? It says it was 29 cents on December the 30th, 1994.
Yeah, so he's got about at least 2.4 million of that 2.5 is going to be taxable. Yeah. Just consider it's all taxable. Your highest tax bracket is going to be 20% on that. There's some surcharges depending on where you go with it. But, if you were to pull out, and by the way, if you're 55 and you want to wait till Social Security age of 62 for your first paycheck, or even 67, maybe you want to spread that Apple situation out a little bit. But let's just say you took for the next 5 years, $500,000 a year, you'd pay less than $100,000 in taxes. And I think it's a small price to pay for all the money you've made and never had to pay tax. And that's the reason that it compounded to such a big number. I would also do it probably while Trump's in office, because after that, If it switches back to the other side, there might be tax increases. That's kind of what they've been proposing on the table. And the tax increase might be getting rid of that capital gains treatment at 15 to 20% tax on that. Now, keep in mind, if you were making $2.5 million in an IRA and you wanted to live on that in the next 5 years, took $500,000 out, you'd be paying tax, in the 30% range, not the 15 or 20. So you actually did better doing the Apple stock and got a partial tax credit or a tax deduction, or call it what you want, favorable tax treatment on that Apple stock. And I think it wouldn't be a bad idea. Good for you for buying it and holding it that long. I mean, I don't know very many people that did that. Most people kind of took profits along the way. And then, as soon as it got to $100 and, went down a little bit, took profits, says, oh, well, that was a good ride. But, little did they know it was going to quadruple again over the next 4 or 5 years. So, you held on for a long time. If you want to use all of it, maybe you just use some of it as it continues to grow, but just use it for what you need to live on. I don't think Apple's going out of business anytime soon. I do think that their earnings have been, struggling a little bit lately, especially with, a discretionary purchase, which is their biggest product, I think, is their iPhone. But, it's discretionary. And when there's inflation, making people have to choose between phones and food, they're going to probably choose food. So, Apple might kind of meander its way along in kind of a range bound for a while. But, I don't think you have to deplete all of it in the next 5 years if you don't want to. But if you did, you'd get out of it with a pretty good tax bracket, and you could reinvest those Apple proceeds into different stocks and different, portfolios that are maybe more in the line of what Apple was 20 or 30 years ago. Some of these AI stocks that have a great bright future, might be the way to diversify into, and it'd be totally worth paying, 20% in taxes in order to do that, because I think the appreciation on those other companies are more than make up for it.
That is some great discipline, Rob. I mean, to hold on to Apple stock for 30 years, that's absolutely amazing. We're all looking for the next Apple stock. Rob, appreciate you listening to us, and of course, we'll send you out Jeff's book, Retirement: The Road Ahead. If you've got a question you'd like us to answer on the air, you can get it to us by calling it in to Shelley, 520-780-9059, or you can go out to the website, primret.com, and leave it there with the contact page. If we use your question on the air, of course, we'll send you out Jeff's book, Retirement: The Road Ahead. And again, 520-780-9059 is our telephone number. If you'd like to come in and sit down with Jeff and talk about your journey towards a confident retirement, there is no cost and there is no obligation whatsoever for that. 520-780-9059. You can also request your plan online at primret.com, PREMRET.com. Jeff, a very short time left in today's show. I know we've got 6 weeks until the end of the year. What are some of the things that we should be looking at as investors that we should be aware of here before the year ends?
Yeah, keeping that in mind, November's a good time to call the office if you are a client, or if you have an advisor that likes to do a little bit of tax planning conversation. Not many of them do out there, but we do. And this is the time to get into the office and figure out your tax plans. Keep in mind, are we in a low enough tax bracket? Did we have enough tax deductions this year in order to, do a Roth conversion and stay in a lower tax bracket and not pay taxes on that money again? Maybe we want to be a little aggressive in our charitable contributions by using a donor advised fund or something where you can actually over gift to charity, and then this year, and then spread it out over the next few years by giving to those charities of your choice ongoing. So if you had a big gain, you can offset it with that. You also, might want to consider what your RMDs are going to be. Make sure that if you have an RMD, then it's going to be based on the value of your portfolio last December 31st. So if you've had some good appreciation, even if it's 5 or 10% in the bond or conservative account, or if it's 20 or 30 or 40% in a more aggressive account, you still only have to take the amount out of that account based on last year's value. So sometimes people think it's, going to be 4 or 5% of what it is today. No, it's last year. Now, keep in mind, it's always good to consider taking some profits when the market's high. So RMDs aren't going to hurt you. You also want to make sure that going forward, you have enough money in safe accounts so that if the market does correct next year, you don't have this year's 12/31 valuation make you pull out 40 or 50% more than you had to pull out last year, and the market gets crushed next year through whatever reason, just because it's due, or just because there's a sell-off, or maybe certain things don't work out the way that we hope so, just because Trump's in the White House, that you end up having to take out or sell a ton more stock out of that portfolio than you would otherwise have to, if the stock market was up. So in other words, when the stock market goes down and you still have to sell twice as many shares to pay last year's RMD, that's not a good thing. So make sure you're diversified. If you're at RMD age, we usually look at that portfolio allocation to make sure that you're set up so that RMDs won't hurt you in the future, as well as make sure you take enough, but don't overdue because we don't want to push you into a new tax bracket. And if you aren't going into a new tax bracket, let's consider Roth conversions as well. And those are just starter conversations. There's a lot more we can talk about.
Well, Jeff, time has run out for our program today. I want to thank you for your time, but most importantly, I want to thank our listeners for joining us. Our telephone number, 520-780-9059, for your no-cost, no obligation, no judgment retirement roadmap. So for Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. This show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.